Well, good morning, everyone. Thomas Montgomery here. We get together most weekday mornings, 8 o'clock Central, to talk about strategies, tips, techniques, share success stories, and support each of you. Today is June 25th, 2024, Tuesday at 8 o'clock on the dot. Today, we're going to talk about kind of a hodgepodge of topics revolving around collateral. So, first of all, and let me even add this to the notes before we get started. So, there's a concept called the three C's. Most of us learned the three C's when we were in probably middle school. And it's just kind of a basic concept of finance, of borrowing money, that if we want to borrow money for traditional business loans, bank loans, we need to have the three C's to qualify. Who can tell me? You can type it into the Q&A. It's like a chat box of Zoom. What do the three C's stand for? Or you can tell me what any one of the three C's stand for. And that's a good opening to our conversation today, which is about liquidation. All right, that's right. So there's credit is one of the three C's. And of course, we're talking about business credit. So the three C's are what's relevant for qualifying for business loans. Chris gave us all of them. So yes, credit is one. The next, in no particular order, is capacity. That means like cash flow, the ability to pay the debt back. And then we have collateral, which is most closely aligned with our discussions today. So credit, does our business show on paper that we've paid our bills in the past? So if we were to apply for a loan, would the lender think that we'll probably pay them back because we've had other extensions of credit that we've paid as agreed with? Positive payment experiences like for Dun & Bradstreet and so forth. So business credit is one of the three C's. Capacity. Does our business appear to have the ability to pay back the debt that we want to take on? Also known as cash flow. And then most closely aligned today is collateral. Collateral, of course, is what are we putting up? What are we promising to the lender that if we don't pay as agreed, that the lender can mitigate the risk? So like if you went and bought a house for your family, the house actually is the collateral for the mortgage, because if you don't pay the mortgage, they're going to foreclose on the house. You go buy a car, the car is actually the collateral for the car loan. If you don't pay the car, they're going to repossess the car. When it comes to business loans, especially working capital loans, we need to make sure that we have collateral. Well, we're very good at helping clients have all three C's. Now, are there some certain specialty types of lenders and funding that only require one or two of the three C's and not all three? Yes. But in general, if what we're trying to do is create a fundable business, we really need the three C's. Not a problem, though. We know the formula, we can make it happen. So today, we're going to talk about liquidation, and that is relevant as part of collateral. So we'll put a little asterisk behind it because that's really what we're getting to today. So one of the things that we provide our startup clients is a free portfolio of receivables. And those are assets, real assets. And I'm going to show you that I've got the screen shared. So we're going to go through a number of different documents here today, so you can see the inner workings, that it's real in terms of the assets that we provide. Well, why would we want to provide a client assets for free? Well, number one, it's part of the contract. We promise to do that. But furthermore, that's because they need collateral. Now, if the client already has enough collateral, then what we're giving them doesn't matter much. But many small businesses don't have enough collateral. That's called a collateral shortfall. Therefore, we transfer additional collateral. And I'm going to show you the mechanics. We're going to lift up the hood and look at the engine today so you understand what that really means and how that works. It's real, it's legal, it's ethical. So that's the background. Let's move on then. So let's go ahead and talk about the collateral. So let's say that we have Annette on this morning. So let's say that Annette comes aboard. She's actually one of our distribution partners. I'm just role playing with her. But let's say Annette has a collateral shortfall. So in other words, on her balance sheet for her business, and maybe she doesn't have a balance sheet, so we have to help her create one, which is fine. That's part of what we do. But on her balance sheet, the amount of money that she wants to borrow is greater than the collateral she has. No problem. We will transfer to Annette or any client additional collateral, but it has to be real, right? We have to avoid bank fraud, right? So we can't just say things. We actually have to do it. It has to be documented. It needs to be legal. So what we could do, and this is not Annette's transaction here, but we did have a client today that we just transferred Jeff Noel's contract to. So we'll start with what's the underlying asset. So in this case, Jeff Noel, real person. I know the name's spelled weird, but that it's pronounced Jeff. He's a real person, great guy, love him, good friend. So Jeff Noel is a client. He signed up for the cheap business address. So he signed a lease with us essentially. And so the name of his business is Hidden Gems. His suite number was 3667. The lease started on March 19th. And then, it's just a normal commercial lease. No surprises. We get down here towards the bottom. Long lease, I guess. We get down towards the bottom. And we see that Jeff signed it. Got kind of a scribbly handwriting, but he signed it. And then he also signed a guarantor. So he is the personal guarantor as well as the business. So unfortunately, Jeff didn't pay his rent. So he went into default. So what happens? Well, so then an invoice is created. So there's the acceleration provision. Jeff didn't pay his rent. So now the entire amount became due plus anticipated legal expenses. So theoretically, this could be transferred over to Annette. So Annette has a collateral shortfall. Let's go back to our definition. So Annette wants to get a business loan in this theoretical example. Her balance sheet is not strong enough. She doesn't have enough assets to pledge as collateral. So we say, hey, no worries, Annette. We're going to transfer over to you additional assets. We could theoretically have transferred Jeff Noel's contract to her. So now Jeff no longer owes us. Now Jeff owes Annette. What does that mean? Now Annette has an accounts receivable. What is an accounts receivable? It's an asset. If it's expected to be received within the next year, which of course it is, then it's considered a current asset. So this is great for Annette, right? So Annette now has an asset, money owed to her business that she can legally, lawfully, ethically, morally put on her balance sheet. So now Annette has collateral. So now we can go to funding. We've resolved that problem. So the process we're talking about today is, okay, so we can transfer very easily to Annette this contract. So we do a bill of sale, which frankly isn't shown here, but we do a bill of sale to transfer the ownership to Annette. So now this contract with Hidden Gems, with the guarantor of Jeff Noel, is now owed to Annette, no longer owed to us. So that's a receivable to her. And so then it's on her balance sheet. What if she wants to collect that money? So it's accomplished step one, which is now she has enough collateral on her balance sheet to get a business loan. That was the immediate goal. But most likely, in addition to that, she will want to liquidate. And that gets us into the rest of the conversation. So what do we do if a client wants to liquidate? So liquidate is a verb, which kind of, as you might assume, means collect the money. So Annette is owed by Jeff. Annette would like to no longer be owed by Jeff. Annette would like to have the money from Jeff. So first thing that normally we would help Annette do is we go ahead and factor the receivables. There's a bank that we use. They will advance 97%. Now you have to apply and get set up and all that, but the bottom line is of the amount that is owed, so we can go over and see how much is owed. So the debt that's owed to Annette is approximately $22,000. The bank would advance 97 cents on the dollar. So let's just say right about 20,000 is what Annette would get. She would get that normally within 2 business days, maybe next business day. So great. So Annette, what have we done? Number one, we have improved her balance sheet. So she has collateral for the loan. Check that box. Now we're helping put cash in her pocket through the factoring. And she doesn't have to factor. Maybe she doesn't want to factor. She could just keep the asset on the balance sheet, not liquidate it, and she still would have the asset to qualify for the loan, the collateral. But most likely, she would want money as well. So we can liquidate it through factoring. If she doesn't want to factor, or if she does want to factor, or if factoring doesn't work out for whatever reason, separate and independent from that, we can also collect the money. Because what's important to realize is when we talk about factoring, the factoring company is going to wire Annette, in this example, approximately $20,000 real cash into her bank account that she can use. That's great. But the factoring company didn't just buy the debt from Annette. She didn't sell it. She essentially used it for a loan. I mean, so this is a great example of using collateral as one of the 3 C's to get funding. So we have some people that come to us and they buy lots of assets and use that specifically for factoring. But separate from the factoring is turning those receivables into cash. And so if Annette wanted, or if anyone wants, they can have us do that. Now we're bonded and licensed to do that, to do this. So if Annette asks us to do that, the first thing that we would do is send a demand letter. And this is an example of a real demand letter to Jeff. Now, again, Jeff is not Annette's asset. It's someone else's, but I'm just using it for example. So we would send a letter to Jeff like we did today. This is real. This went out to Jeff this morning. We would blind copy Annette. One of the things that we do when we're liquidating the receivables is we keep the client, like Annette, out of view, because sometimes people get kind of bitchy, kind of ugly. And so Jeff really owes the money to Annette. There's no question. There's not a bit of question in the world that Jeff signed this. And in fact, we can even show down at the bottom the document reference number. We know the IP address of where Jeff signed it from. It has 2-factor authentication. There's just no question that Jeff signed this lease and owes the money to Annette. However, Jeff might get a little pissy when we're trying to collect the money. Sometimes people don't want to pay. So what we do is we protect the client, in this case, Annette. So Annette is out of view. We're collecting the money on her behalf. So that's why this invoice would be sent, this demand letter would be sent to Jeff. So we're clarifying why we're reaching him. Now, we're not playing any games, right? So we're going to actually send Jeff a copy of the lease he signed, right? This whole long document, I guess it's 26 pages. So there's no question that he signed it, that he promised to pay. We're going to also send him a copy of the invoice so he knows what we're asking for on behalf of Annette, and then the demand letter. So we clarify in the letter, here's the debtor information. So in many cases, the contract is a business with a personal guarantee. And you'll see that this was signed by Jeff Noel on behalf of his company. Interesting that Jeff didn't capitalize the G in Gems. I don't know if he's not very literate or if that's like a branding idea. But anyway, that's the name of his company. And then as I showed you down at the bottom, Jeff signed a guarantor and he said, yep, I'll back it up. If my business doesn't pay, I'll take responsibility for it. And that's stated here. So we clarify that when we send the demand letter to Jeff. We clarify when the contract was signed, but we're also providing the defaulted contract with the communication. So there's just no confusion. It's not like we're trying to extort someone. Clearly, Jeff owes Annette the money, and we're collecting it. And then let's go back to the demand letter. So of course we know a lot about Jeff. We know his social, we know his date of birth, we know his driver's license number. So all of that we're going to need when we actually file the court case. Now the goal is to not file the court case. The goal is just to get Annette her money, right? Annette doesn't want us to have to go to court with Jeff. Annette wants just the money. Jeff owes the money. He's not paid the money. She just wants the money. So hopefully we don't even have to go to court. But what we're saying is, Jeff, you owe Annette the money. You need to pay or make some sort of payment arrangements that Annette agrees to. And if not, we're going to sue you. And again, we just reiterate, you can't say it wasn't you. One of the common defenses that debtors will say, well, I didn't sign that. That wasn't me. Oh, yes, you did. I mean, we've got your IP address. We've got a unique document number. We've got the full contract. Yes, you signed it. So we'll get past that that alleged defense of, oh, it's not mine. It's definitely his. So in many cases, we'll seek to settle the amount owed because it accelerates it. Because the quicker that Annette gets the money, the happier she is. And so we'll try to work with the debtor to collect if the debtor makes it, the debtor meaning Jeff, the person that owes the money. So if he says, well, I can't afford to pay $21,998.80, but I can send you $17,000 today. So we'd go back to Annette, say, Annette, Jeff, the debtor's offering $17,000 even. He's willing to wire today, yay or nay. And she might say yes, she might say no. Or maybe Jeff doesn't have $17,000 or $21,000. He says, hey, I'll pay $2,000 a month for the next 12 months. So we go to Annette, say, is that good enough? The bottom line is the demand letter goes to the debtor, a copy of the defaulted agreement. This is called the media that substantiates it, copy the invoice, and then also what's not shown here is a bill of sale that shows the ownership of the asset was transferred to Annette. So with that being said, what questions do you have? This maybe is more details than you need to know, but what's relevant is you and I together help people qualify for funding. At the core of that is a concept called the 3 C's. That's irrefutable. You talk to anyone, any accountant, any finance person, any business attorney, any banker. I don't think anyone would say the 3 C's aren't it. That's what it takes to qualify for business funding. So what we do is we help people build their business credit. We help people's businesses build their business credit. We help them have the documented capacity and cash flow. And as discussed today, we help them make sure that they have the collateral. The way that we can provide the collateral is by transferring real assets, just like this one. This is a real one that we transferred. And then from that, we can help the client factor the receivables. And furthermore, we can help them collect the receivables. So of course, our information's here, but let me open it up for questions, comments, concerns. So Chris is asking a good question. So the factoring terms are set forth by the bank that does the factoring. My understanding is that it's 0% interest for the first initial term, and then after that they charge market interest. But we have to be real careful to not quote financing terms because we're not the lender. So we're not authorized to act on behalf of Wells Fargo or JP Morgan Chase. But the point is, we can help facilitate the application for factoring. The factoring company, that the bank will extend the offers or offer to the client. But I believe in every instance, the offers have been 97%. All right, Samuel's asking, can people get multiple portfolios? Sure, yeah. So we're running a promotion actually this month, which we call Quick Cash, where clients can buy 2, get 1 free. So instead of just getting 1 defaulted agreement, so instead of just 1, they would get 3. They would pay for two and get one free. We charge a title, and I guess we should put that on the screen. So we charge a title transfer fee. Title transfer fee. That is $499.99 per portfolio. Because again, and we've talked about this in other trainings, I guess I haven't mentioned it today. When assets are moved, ownership from one person to the next, it needs to be properly documented. So for instance, Chris, if you had a car and you wanted to give to me, could you just say, hey, Tom, here's the keys, it's your car now? No, we'd have to get the title of the car put in my name or it's not my car. Or Chris, if you had a piece of land you wanted to give to me, can you just say, hey, Tom, it's your land? No, we'd have to go to the title company and get it deeded into my name. Well, when we're transferring assets, we can't just say, oh, Annette, it's yours now. You have to have proper documentation, including a bill of sale, which again, I should have pulled up here. I didn't pull one up, but the bottom line is that is part of it. So yes, there's a cost to transfer the asset over. It's $499.99, essentially $500 per portfolio, but we have the buy two get one free promotion going on in June through the end of the month. Is that it? No, it's a 25-75% split. So in this case, Annette would get 75% of the money collected. Oops. And we would get 25% because it's our asset we're transferring over, right? We could have just kept this and we could have just sued Jeff or collected from Jeff and just kept Annette out of the deal. But if Annette wants this and it helps her, so the reason we do this is not to make money. We do this to help clients qualify for funding because there's 3 C's and some people don't have collateral. Well, if you don't have collateral, what do? We either need to reduce the loan amount to the amount of collateral we have, or we need to increase the collateral, which is what we're showing here. So with that being said, I just wanted you to understand better how this works. It's legal, it's ethical, it's moral. The biggest deal we've done, and I've told this story before, but I think it's noteworthy. The biggest deal we've done in one transaction is a $3 million transfer, and that was to a law firm. A large law firm. So yes, buying and selling of debt instruments, which is really what this would be called, is mainstream. There's several publicly traded Wall Street businesses that do this, including Encore Capital out of California. They do over $1 billion with a B, billion a year. We've just broken this down into small increments so clients can use this to do a couple things. Have collateral on their balance sheet, and then turn those receivables into cash. So with that being said, if there's any assistance that you need, obviously our phone number, our email. There's no real action step today. It's not like, oh, go do something. I just wanted you to understand what this is and how it works. And I guess at the most basic element is just know what you and I do is real, it's valid, it's needed. We help people qualify for funding. We help them have the credibility, the fundability on paper, legally and ethically to qualify for funding. And so that means we're going to help them build their business credit. We're going to help them document adequate capacity, otherwise known as cash flow, to qualify for the funding and pay it back, and collateral. So today we focused on one of the 3 C's, kind of the inner workings of how we provide collateral. And we took a very, very transparent look, right? This is a real invoice that went to Jeff this morning. This is his real contract, right? This is it. This is not a fake or pretend or example. This is it. And then this is the real demand letter that went to him. So if you have any clients that need collateral, that need funding, let's get them into your landing page. We'll take care of it. You're paid 5 points of the client's capital raise, minimum of $5,000 per deal. All right. Thanks, everyone. We'll see you back tomorrow morning. Have a good day. Bye-bye.